So today we have a special episode of Trade Ideas. Ahead of the big Fed announcement, Rick Bensignor of the Bensignor Group is going to find out how Mark Yusko of Morgan Creek Capital is making sense of markets and how he's taking advantage of the current setup. Please enjoy.
Hi, everyone. I'm Rick Bensignor, CEO of Bensignor Investment Strategies. And today we have the pleasure of talking to Mark Yusko of Morgan Creek Capital. So, Mark, thanks for coming with us today.
Great to be here.
Sharing thoughts. We're going into a really big Fed meeting tomorrow. The world is is waiting for this. Markets have quieted down for the last 2 weeks. There's a ton of emphasis on what the Fed's going to do.
Yeah.
What do you think Mr. Powell is going to send as a message to the U.S.?
Look, I think it's going to be one of those very anticlimactic events. I think he is going to cave to the political pressure to cut, even though I think it's a huge mistake. I think it's been a mistake since day one to take interest rates down this low, given all the positive. We're in the greatest economy ever, according to our tweeter-in-chief. If that were true, then we clearly don't need an interest rate cut. 25 basis points does nothing. Right? That doesn't change anything economically. You and I don't borrow at Fed funds.
Right.
So it's just a waste of people's time and energy. He's not going to cut 50 basis points, I don't think. He's certainly not going to cut 100 basis points like our president would love him to. And low interest rates don't solve economic problems. If they did, then Japan would be rocking. Europe would be rocking, which they're not. So I think it's all kabuki theater.
Back in May, a couple months ago, you were on CNBC, and you said that we're already in a bear market.
Yeah.
All right. So since then, the S&P is up almost, close to 6% or so, which in the grand scheme is not a big move away from where you said there's a bear market, but we're virtually on all-time highs. We're not even 1% in the S&P terms away from all-time highs. So going into this Fed meeting, if the market comes out bullishly from here, at what point do you say, well, let me ask you this. Why are we in a bear market? Breadth shows that this is not a FANG-led rally. We have great participation across the universal investing space. Yes,
kind of.
Well, if you look based on breadth, you're virtually on all-time highs. It's very much tracking the S&P. So there's nothing bad going on in the breadth sense. The only thing that's really lagging are small cap names. Okay. The S&P is 1% from all-time highs. Where's the bear market?
This goes all the way back. It's not really to May. May I reiterated what I said in September, and then what I said a year ago in January, and actually what I wrote in November of the previous year was that when Trump got elected, I called it welcome to Hooverville, right? He's Herbert Hoover reborn, only third president with no experience to get elected. And I thought the same thing would happen. We have this big rally to around 2,800. That would be the peak. I thought it would happen in kind of September of 17. I was early, euphemism for wrong. It really happened in January 18. We got to 2,850.
Right.
And we're basically flat since then. Right? We're up 6% since then.
Right.
And that's 3 points of inflation and 3 points of basically dividends. And so we're basically flat.
Okay.
So I could say I'm wrong. People want me to say I'm wrong. Fine, I'm wrong. But I'll just say I'm early. We've been basically flat for 18, coming up on 19 months.
Okay.
We're second most overvalued in history of markets.
Correct.
And so if people get excited about the Fed cutting 25 basis points tomorrow, and they think that matters in the big scheme, and markets rally, I'll just sell more.
Okay.
I'll get more short. Look, I'll argue over the next decade, from here, from this point, and actually from 18 months ago, so I'll take credit for the full 18 months. From 18 months ago, for 10 years, you're gonna have a negative return on the S&P. So why would you want to own that? There are so many other things around the world that you can own that you're gonna make far superior returns. Bitcoin's just one of them. Lots of things that you can own that are going to do much better than that.
Such as, besides cryptos, which have had a really tough time. We've had a good rally this year. And recently, I think we got close to 14,000 or so in Bitcoin.
It's actually the best performing asset this year.
Yes.
Over 1 year.
But
over 2 years. Over 3 years. Over 4 years. Over 5 years. Over 10 years.
Better than
gold?
But
other than that, way better than gold.
Yes, you're right. But
other than that,
it has
let's
very
go
small
off crypto.
Very small participation.
200 billion market cap.
And I am so far away from recommending to institutional clients to play the crypto space.
It's all coming. Another topic for another day. what to buy today? I'll call it the hashtag China playing go trade. Everybody thinks we're winning the trade war. We are being crushed in the trade war.
Why?
China's so far ahead of us. They're 3 moves ahead. They're playing a different game. They're playing go, while Team Trump argues about how to set up the checkerboard. They're not even playing the same game. There was a deal 3 or 4 months ago that China would have signed. Okay? And then Trump, at the last minute, came in and said, no, you have to admit wrongdoing. And they're like, go away. Go away. So there's not going to be a deal. There's no deal coming. He said this morning that everything's going well. No, it's not.
No.
There's no deal. There's not going to be a deal. China's killing us.
Well, it
in the
sounds like
things
there's
that
no
matter.
incentive for
Oh.
either China or Trump to make a deal happen right now.
No, this
so
is
meetings that are
all-
starting right now are really not going to progress.
It's
And
all
in fact, gold's
posturing.
up today another $7 because Trump's saying there really is no reason to rush through this, and it's certainly politicized. He's starting, November starts his year into the next election. And if he wants a China deal to happen, it would certainly be more beneficial to him to have something happen during the election season to say, this is another thing we've accomplished. So for months, and it could easily be 6 to 12 months, he doesn't need this deal to happen.
We can't vanquish the enemy until it's important and makes a splash in the press. So we always need an enemy, right? He creates enemies to topple, okay? There aren't enemies, right? There was no problem with North Korea. There hasn't been a problem with North Korea for decades. But he creates a problem and then goes over and doesn't get a solution and then moves on to the next thing. So now it's Cold War 2.0 and Huawei. This whole thing about Huawei, 10 years ago, the US and China had to make a decision. What were they going to support technologically? We supported the FANGs, so we are the world leader in social media. We're awesome. They decided to back AI and 5G. So they're the world leaders in 5G, right? You get off the airport or get off the airplane in Mexico City, plastered billboards everywhere you can see, 5G from Huawei. Go to France, whole buildings draped in that fabric that says 5G from Huawei. They're killing us in 5G rollout. And so we had to demonize them and create this Cold War kind of Ruski kind of enemy. The reality is China's just doing what they do. They're leading in technology, they're filing more patents, they're graduating more engineers, they're building better companies. And look at Tencent and Alibaba, again, eating our lunch. So the great trade is long China, particularly the A shares, and short the S&P.
That's interesting because I got clients back into China early this year.
Yeah.
We had a big move. We actually sold out and came back in June.
Awesome, love it.
So-
that was a better trade than my trade because I've been long all year, but you had a better trade.
Yeah.
But you're a trader, I'm an investor.
Yeah. So I agree with you that China is a place. Now, would I buy China and be short the U.S.? I don't know because the S&P is seemingly the only place to be that continuously makes money. And
Yeah,
again,
but
you
the
can't argue
Tina-
with all-time highs.
Well, the Tina trade, I think, is so overdone. And like I said, the S&P is basically flat for the last 18 months, okay, after dividends and inflation. Earnings are collapsing, right? Horrible earnings season, more horrible earnings this morning, bad earnings. So we're going to have 2 consecutive down quarters of earnings. I believe we're actually going to be in recession sometime over the next 4 quarters. But when I say recession, I don't mean like a collapse like global financial crisis. I mean kind of 2001, kind of 1% average growth over 4 quarters. That's a recession. Shallow, but still a recession.
Right.
And I think that the S&P is going to follow. And look, I said last October that the S&P would fall 40% to get to fair value. Well, I'm only wrong in the sense that it's not down 40. Now it went down 20 and it's rallied back to even, about where it was last September, October. But we're not wrong until we're at the end of the period, right?
Correct.
So I got 8.5 years to be wrong.
December, we got down in S&P, I think it was 2350, give or take, a couple
Yep.
points. We've
Yeah.
rallied significantly from them.
Yeah.
By early January, I told my institutional clients that that low was not only a good trading low, but the cyclical low. So I've been in the camp that we will not go down to that level again. It will not
Yeah.
be tested. What do you think?
I don't want to debate right here, but we could. But I like your perspective, but I think we're going to go lower.
Lower than December's low?
Yeah, I do. I think that was halfway. I think we're going all the way to fair value. I think just like in 2000, 2001, 2002, and the way I thought about it was it would play out in exactly that way. From September of last year to September 2 years hence, so September 2020, right? I thought we would have down single digit in 2018, down double digit this year, okay? And then down 20+% when the credit crisis really hits in 2020, just like it did 2002. Because remember, in 2000, the market was really overvalued, but people didn't really get unhappy with the market until 9/11. It was really, 2000 was down 9%. 2001 was up for most of the year until 9/11. And it was only in 2002 when people realized that all this telecom companies were really fake. Enron, WorldCom, et cetera. And there are a whole bunch of companies that shouldn't exist. 1/3 of the Russell 2000 don't make any money.
Right.
The only reason they exist is because of these artificially low interest rates. If interest rates were where they should be, short interest rates for over 140 years have been equal to nominal GDP. Today, nominal GDP around 3.5%. That's where interest rates should be. But we're keeping them artificially low because that enriches the people at the top of the pyramid. And if you believe, back to our original conversation, that's why the Fed exists, then good, that's what they're doing.
So before I let you go, I want to talk to you about something that's near and dear to me, which is trading oil. I know it's a market you have a lot of interest in.
Yep.
I trade it almost daily. And I will tell you that from somebody who's traded commodity markets almost 40 years, it has become one of the most difficult markets to trade. It moves $1 like nothing.
Yeah.
You hit a bid, and the moment you hit the bid, it's 25 cents against you. Machines have taken over
Look,
this.
I'm so glad to hear you say that because I probably haven't been this frustrated about a market in my whole career either, in the sense that we do a lot of work on the oil space because we have a lot of private investments, in the best basins around the world. And so we have really good insight and good knowledge on what's happening. And the supply of oil is off the charts, particularly in the US, particularly in the Permian. And so the price should not be strong this year. And there's been this crazy rebound, very similar to 2016. Remember 2016, we were down to $20 a barrel. It was going down. Raul was saying it was going to $10. Everybody was bearish. And literally on a dime on February 11th, it turned and went up. And it was only a quarter later we found out why, was the Chinese were buying huge amounts of oil futures to basically bail out the market. They pumped $1 trillion, trillion with a T. Remember, that's $1 a second for 31,710 years. Trillion's a big number. But they pumped $1 trillion to save the world in 2016. And you had small cap rally, and then the markets rally, and everything was glorious. And we solved the recession that we were in. The PMIs were all low. Well, now, oil prices were rallying straight up, and then boom, they fell off a cliff right before the midterm election. Shocking, I know, it got low oil prices because, there's this funny correlation between price of gasoline and presidential popularity.
Oh, sure.
It's a perfect inverse correlation. And so what was interesting was that fall then went out of control. To your point about just being crazy, is it crashed right through 50, right through, low
got down
40s,
to
$42.
Yeah.
You're like, what's going on? And so then this just, again, V-shaped bounce. But when we looked at the supply, U.S. production hit 12 million barrels a day, which 5 years ago people said was impossible. And so it just didn't make any sense to us. But then you start looking at the futures market again, and there was this money, some of it Chinese, but some of it comes from places I don't understand because I'm not in it day to day.
Last fall, oil peaked at just under $77 a barrel in the front month. And 2 weeks later, I was on Bloomberg TV being interviewed, and I said, that high is not just the high near term. It's a cyclical, if not secular high.
Yeah.
And the feedback I got was, you're crazy. It's
crazy.
going to $100.
Yeah.
What do you think? Are we going to revisit that? Is there a good likelihood? Because the bounce off of 42 got to 66 and change.
Yep.
We're sitting around $58 today, give or take.
I think you're so wise on that because at that point, not only was everybody talking about triple digits, there were some people talking about $300, that there was going to be this super spike if the Strait of Hormuz was shut down, which now we're talking about maybe happening. Now, if that were to happen, right, if there is a conflict which is being created, I think artificially, probably to prop up oil. Look, there's one group in the world that needs triple-digit oil prices, the Saudis. And we will do or say anything to help them, as we've proven. They can do anything they want, irregardless of law or ethics, and we will support them. So they want to get Aramco public. They need high oil prices to get a high price for Aramco. So I wouldn't be surprised if suddenly another drone gets shot down or something happens. And I love the headline about the Iranians seizing a British tanker. No, the British seized 2 Iranian tankers in the morning and they just retaliated. So let's get the whole story. But I do think there's risk of a super spike. But I think the secular peak of 77, I'm right with you. And look, we are awash in oil. It's not as bad as kind of the 98 cover of The Economist magazine where oil was going to go to $5 and The Economist actually said someday it might be free. Okay, that was a little extreme. But we have so much production capacity in the United States because of fracking technology. And this is a great example where technology has taken a commodity and made it ubiquitous, right? We didn't think for years, in fact, I used to tell the story that we had all this oil, the size of Saudi Arabia, in Midland, Texas, or under Midland, Texas. If you can see the airport, you got great oil. But you had to drill a mile deep, insert a tungsten steel rod, and heat it to 700 degrees Celsius. I said, that just seems expensive. But then fracking came along, we didn't have to do that anymore. So now we can get this oil out of the ground, and that's pretty amazing. So supply, really negative for oil prices. Demand, now we're not going to have everyone have electric cars next year, but electrification is going to continue to go on, and that's another bad thing for demand. But urbanization will counter a lot of that. You got 10 million people a year urbanizing in China. You got a big urbanization in India, and you got affluence increasing. So that'll increase the demand for oil. So I don't think the demand side's going to collapse like some people think.
No,
So
I don't think so either.
I think we're in a range 40 to 60. Anytime you get low 40s, then we're going to help prop it back up to help the Saudis. The other thing that we could spend all afternoon talking about is what's happening in the global reserve currency. Right? 1971, we go off the gold standard, we go to the fiat standard, we really go to the oil standard. So we cut a deal with Saudi, we say, we'll protect you if you price all oil transactions in dollars. Then what happens? Anyone who threatens that disappears. Libya says we're going to price in gold. Gaddafi, gone. Iraq says we're going to price in euros. Hussein, gone. Now, if you're Russia or China, and you say we're going to price in renminbi or ruble, well, I can't get rid of those guys because they got nukes. So we'll just negotiate and we'll try to make petrodollar standard better. But the petrodollar standard is now going away because the U.S. is exporting oil, which decreases the demand for dollars.
Yeah.
So we've got this really interesting dynamic, and there's a lot of things that are making your and my job really tough in the oil market.
Earlier this year, and I'd say it's probably the home run trade of the year that I've had at Bensignor Investment Strategies in February, we went long the solar ETF, TAN, and shorted XOP, oil and gas names, against it.
Nice.
It's worth over just about 35% on a pair trade.
Fantastic.
So I'm a big believer that the future in the energy space, and by the way, if you look at XLE, the energy space versus the S&P, this past week, again, we made new relative lows for 2019, and we're on the lowest lows in 19 years. You have to go back to 2000 to see the last time XLE divided by SPY is at this level.
Absolutely.
The last 10 years, XLE versus SPY peaked in 2010. Only 2 out of the last 9 years has the energy space outperformed. It's been a disastrous long-term buy. Now, you can make money on individual names, but you could have gone in any other sector of the market and done better.
Yeah, well, bringing it all back to what we came here to talk about, the Fed, it's because of the Fed, right? The reason that the energy business has become such a sucky technical term business is because of free money.
Yeah.
So free money, low interest rates, all these companies levered up, they can't generate cash flow, so they've got all this demand from the market, from Wall Street, to put up production numbers. They're producing more negative free cash flow, so they're just burning through cash. Well, if you can borrow for free, then you would keep doing that. But now, with the threat of people saying, oh, there has to be discipline in the markets, you're starting to see some of those companies go out of business. So XLE and XOP, some of those companies are in big trouble.
Yeah.
And what's eventually going to happen is a massive wave of consolidation. There's going to be a great opportunity on the long side at some point to buy up all the small companies that are going to get folded into the big companies.
Correct.
But long term, that trade of long solar, short oil is a good trade. And it's, that's why your tactical approach with this fundamental approach is really good.
Mark, thanks so much for joining us today. It's been a real pleasure and always great insights from you.
All right, it was really fun to talk about long-term stuff, short-term stuff, tactical trading, investing. Really great to be here with you.
We'll have you back again.
Thanks.